All right, so you're 65, you saved $1 million in your 401k, and you go to make that first distribution, and you finally figure out how high your taxes might actually be in retirement. Stay tuned as Jay and I discuss why maybe having a multi-bucket strategy is the way to go.
Well, Happy New Year. Happy 2026. Welcome to T-Minus Retirement, the podcast where we help launch your retirement into orbit. I'm Jay Cole.
And I'm Dustin Watts.
And like Dustin mentioned in the intro, we're going to be talking about what's commonly known as saving up different buckets for retirement versus just having all your eggs in one specific type of basket. And how that could potentially be better for you, especially when it comes to taxes when you're at retirement and need to take distributions just to live off of. So go ahead, Dustin.
Yeah, and this kind of came about just because we've had situations in the past where a client, does a really good job of saving. They max out their 401k. They're getting all that money in pre-tax each year, which is great. We're not going to knock anybody for that. But unfortunately, if they haven't saved maybe in an after-tax account or potentially a Roth account, they find out that when they get into retirement and they need to take, maybe it's a big distribution for the purchase of an asset, or just depending on how much money they need each year to live, they find out pretty quick that they end up being in a lot higher tax bracket than maybe they thought they were going to. So Jay and I just thought that this would be a good discussion to demonstrate, why it's a good idea to have these different, buckets of money. Maybe it's a pre-tax, a Roth, and an after-tax brokerage. If you have these different buckets of money, you can control your tax bracket a lot easier, especially if you're needing to, make a big purchase. Obviously, you retire. A lot of people, maybe they buy an RV, or they buy, a boat or a piece of property. So to have the flexibility in retirement with this bucket strategy makes a lot of sense.
Yeah, and just to quickly define those types of three accounts. So you got your traditional pre-tax accounts. So like Dustin mentioned, that's going to be 401ks, IRAs, and the majority of people have those. Those are accounts that you've made contributions throughout the years, and they're all pre-tax, so you get a tax deduction for doing so. And when it comes time to you're retired, you're above 59 and a half, and you take a distribution, whatever you take out per year is fully taxable. So depending on what your tax bracket is, then that's what's going to be taxed. Roth accounts, so Roth IRAs, Roth 401ks, that's a newer thing, but those are starting to become more common now. Those are retirement accounts where they're considered after tax. So any contributions you make into those accounts, you already pay taxes on that, so you don't get a tax deduction for it. But the benefit of that is whenever you take money out of it, it's tax-free. Also, and this is even the bigger benefit, whatever it's made or it's grown throughout all the years, you don't pay any taxes on that growth. So like, for example, if you have a Roth 401k that's $1 million, and throughout the course of its lifetime, you've contributed $500,000, and the rest of it is just growth, well, that whole $1 million is tax-free. So that's the nice thing to have. You just don't get a tax write-off in the year that you're making those contributions, but it's a good down the road benefit to have. The final account, your traditional brokerage account, that's going to be taxed similar to, kind of view it like how you see your bank accounts when you get interest or you have a CD with the bank. Whatever that account makes in interest and in dividends, those two are taxed. And the interest is just taxed as ordinary income, and the dividends, depending on how long you've held the investment, is taxed either as ordinary income or at the capital gains rate. But bottom line, whatever income those accounts make are taxed on your tax return for that year. And then if you make any sales of any investments or stocks, if there's a gain involved, you're going to only pay taxes on what that gain is. So if you had 10 grand of like Apple stock, 5 grand of it is what your initial purchase price of it was, and it's appreciated to 10 grand. If you sell that whole 10,000 share of Apple, only 5,000 is going to be taxable. And just a little caveat on that, if you've held that stock for over a year, then it's taxed as long-term capital gain, so it's taxed a bit more favorably. If it's been under a year or less, then that gain's just taxed as ordinary income. So whatever tax bracket you're in, that's just going to be taxed that as well. So those are those three different types of accounts. And what we quickly did was on a tax software that we use, I'll show you here in a second, we did a plan where we have a retired couple, they're 67, they essentially need about 100 grand a year just to live. And so the first example is going to have them only have 401k or IRA money and then Social Security, a little bit of interest too, but it's just that. And then the second example is going to be them with IRA money, with brokerage money, and then essentially with Roth account monies as well. So we're going to show what it looks like if a retired couple in their late 60s who need 100 grand a year, what the differences in taxes would look like if they just had pre-tax money versus if they had all three combined. So I'll share my screen here. All right, Dustin, can you see this pretty good?
Yep, looks good.
Okay, so we have Tom and Tammy Temecula. So plan one is going to be that initial plan where they only have pre-tax money, a little bit of interest in Social Security. So we got about $1,000 of interest. That's kind of common with most people. They have some monies in savings or maybe a little bit of a CD, but get about $1,000 a year in interest. They withdraw 50 grand from their IRA, and then if we zoom in here, they have combined 50,000 of Social Security. And if you remember, not all of your Social Security is going to be taxable. It's going to be up to 85% of the benefits that are taxable, and that's just depending on what other income that you have. So in this case, we're pretty much at the full 85% taxable. So we have that. That gives us an income of 101,000, but essentially satisfying what the client needs just to live for the year. So if we take that, what's taxable is 84,200. For 2025, their standard deduction, so let's just say they don't really have any write-offs, their standard deduction is 34,700 for a couple at that age. And then this is new for tax year 2025, and it's going to be for the next 4 years unless they extend it. But any senior above the age of 65, essentially if their income's below, I want to say 150,000, they get each a $6,000 senior tax deduction, and that's on top of the standard deduction. So that's another 12,000 that we can deduct from their income. And what's left is taxable income. And this is going to be essentially where we derive our tax bracket from. So that's 37,500. And based off of that, their income tax off of that's going to be about $4,026. So that's how much they're going to have to pay in order to have 100 grand a year just based off of their scenario. Does that make sense, Dustin?
It does, yeah.
Okay. So option two, this is if they had pre-tax IRA money, Roth IRA money, and then brokerage accounts money. This is if they had all those three options and they needed to satisfy a living for 100,000 a year. So obviously no wages. I still left in the $1,000 of just interest. Kind of zoom in here, just bank interest. But now that they have a brokerage account, they're going to be paying taxes on whatever dividends that account makes. So let's just say for the year, their account generated about $8,000 of qualified dividends. So this is long-term. They've held these investments for long-term, and they're taxed at a much favorable tax rate. So they've got $8 grand of dividends. With brokerage accounts, so whenever you take cash directly from those accounts, it's not a taxable distribution. It's just like if you're taking cash from your checking or savings account. What's going to be taxable again with those accounts is if you need to generate cash. Let's say you need 20 grand for a new roof repair and that brokerage account doesn't have any cash, you're going to have to sell 20 grand worth of whatever investment you want to sell generate that cash. And if there's a capital gain involved, again, we're only going to pay taxes on that gain. So let's just say that throughout the course of the year, their account had long-term gains of 15,000 that was recognized. So that could be through, if they had to raise cash, that could be through if there was a rebalancing or if they wanted to get rid of a position. But overall, long-term for the whole year, the brokerage account generated 15 grand of capital gains. And then also with they still have an IRA. They're taking only 10 grand out of that just because they want to minimize as much tax as possible. Their Social Security is still at 50,000, but since their income now is a lot less, only 18,750 of it is considered taxable. So already their income's a lot less. And it's not going to really show up on here, but whatever else that they need for an income, they can pull from their Roth IRA, and that's going to be all tax-free. And that's not going to show up on the tax return, so we can't really show it here. But let's say that after everything is said and done, they still need 20 grand left just to satisfy their living needs. They can take 20 grand from their Roth IRA, and it's not going to be taxable, and it's not going to change anything, so it won't show up on here. But right off the bat, you can see their total income before deductions and everything is much less, 52,750. Take that standard deduction and the senior deduction, and now what's left, their taxable income is only 6,050. And the best part is because the income is so low, their tax is zero. So they don't have to pay any federal tax.
Wow. So pretty much to kind of summarize that is just because, they get the same amount of income, but they're able to just have flexibility on where they take that income from and virtually go from, having to either prepay through withholding or send in estimates, on that first scenario to literally paying zero income tax in retirement.
Yeah, and this is a overly simplified example, but it still conveys the importance of just having those multiple accounts, because even with a brokerage account, let's say you have to raise cash and you're going to have a pretty big gain, you can help offset that gain by selling some stocks or investments that have a loss just to help negate that tax.
It makes a lot of sense, and Jay and I see it all the time of having these different accounts, and the benefit is, when you work with a team that can help you strategize on where to take the money from to be the most tax efficient. If you have those different buckets of money like we talked about, I mean, I don't think anybody would complain about getting 100 grand of income in retirement and paying zero income tax, because then you're getting kind of the best of both worlds, right? You saved money in a deferred account and you're able to take some of it out basically tax free.
Mm-hmm.
So, I mean, there's really, you're kind of winning on both ends of the equation on that scenario.
Yeah, exactly. Plus, too, if you're spreading your savings between those three different accounts, that lowers what your required minimum distribution is once you're at that age, 73 or 75 if you're, whatever year you're born in. And with the required minimum distribution, if you don't necessarily need all that money, you still have to take it, recognize it, pay taxes on it, and then go from there. So if you have different accounts that you've saved in, maybe that IRA or 401k is not $1 million, but with adding everything else up, you might have $1 million or even more.
And, just to be clear, Jay and I are not saying to stop making contributions to your 401k so that you can contribute to a brokerage account or to a Roth account. But what we are saying is, you need to work with professionals, and if you need that help, please give us a call. But you need to work with a team that can help you determine, okay, how much should I be saving in my 401k to maximize, my taxes while I'm working, get the employer match and all these different things. And maybe you are maxing it out and you still have some left over to fund brokerage accounts and things, and set up a strategy to do that on a periodic basis, because when you get to retirement and you need to be drawing income, or when you need those one-time purchases, you'll thank yourself and you'll thank us later by having those different accounts to pull from, because you just won't get whacked from a tax perspective when you go to make those decisions.
Exactly. Yeah.
Well, awesome job, Jay. Thank you for the detailed explanation. And again, if you have questions yourself on how to set up a strategy like this, or kind of where you're currently at, feel free to give us a call. But we appreciate your time. We hope you found it informational and educational, and we look forward to seeing you in the next video. Take care.